Good morning, everybody. Welcome to the Flow Show. We're picking up a bit now on the old volatility. Lots of things happening. All good stuff to get our teeth stuck into. Morning, Kay. How you doing, mate?
Hey, good morning, Ryan. Good morning, everybody. Yeah, we're doing all right, mate. We're doing all right. Last day of February, leap day. There was this funny thing about in New Zealand, right, where some of the gas stations saw glitches because of the clocks weren't prepared for a leap day. That was really funny.
Ridiculous. I assume those garages are less than 4 years old then, because surely the other ones must have been gone through a leap year before. Well, anyway, probably a few more of those stories, no doubt. Right, let's get over. So let's get cracking. China's Securities and Regulations Committee has vowed strict supervision on high-frequency traders or high-frequency trading, all those naughty fellas messing around with their stock markets. So they're going to stick the hammer on those guys. We'll kick off with a bit of data. Starting in Japan, we had industrial production numbers, which some good, some bad. January's month-on-month numbers much worse, but then we had some forecast for production ahead coming in much better, so maybe a bit of an improvement coming in the pipeline, but on the face of it, much worse on the month of January. Retail sales looking okay-ish, 2.3% beating expectations, slightly lower than the prior month, which saw a higher revision. Japanese Finance Minister Kanda has been waffling on at the G20, talking FX, the usual lines coming out from him, watching market volatility, has to move in line with fundamentals, blah, 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 blah. But the big news really overnight was from BOJ's Takata saying that the price target is coming into sight and that momentum is rising in the spring wage talks, with many firms offering higher than 2023 wage hikes. You'll think that these guys have got their ears closely to the ground regarding those. Says seeing wage hikes broadening stronger than last year. We need to watch the outcome of spring wage talks after mid-March. That's when we start getting the Rengo stuff coming through. Says that high wage hike rate prompts continual expectations for households that incomes will rise. Then we got stuck into the ending of easy policy, saying that the exit measures include abandoning YCC framework, ending negative rates, and an overshoot commitment. So that's going more than maybe necessary. Says we need to weigh a nimble and flexible response for an exit. He's said those comments before. He says, in case for entering a policy exit, we would need to conduct appropriate steps while paying attention to the health of the balance sheet. It says he would call for a gear shift in policy, so not going backward. So once they start going, they're going to keep going, not going backwards at all. He says a moderate recovery trend is intact despite the slowdown in capex and consumption. So brushing over a bit of the weaker data we've seen. On ending negative rates in March on April, he says he's not made up his mind yet on his monetary policy decision. So potentially keeping March and April as live meetings for when they might change. He says he's not thinking of rate hikes one after another. There's the slow and steady approach. And he says amid mixed circumstances surrounding small firms, they will need gradual steps. So that's one of the big worries there. It's okay for some of these big companies to hike wages and plow on, but it's going to be a harder task for smaller firms. And that's why Kishida's putting in measures in place, tax incentives and the likes, because it's not just the big firms that need to move, it's everyone, including the small firms. So probably the most detailed comments about the exit, timing in there as well, what they're looking at, how they're going to approach it, slow and steady, as we know. Nothing there is maybe not what we expected, but the markets had confirmation of that now, and thus we've seen dollar yen or yen pairs having a little sell-off, which are now bouncing as I expected this morning. I managed to go long and then fear myself out of the trade earlier on. Okay,
yeah,
on the move. We're painting in, we're colouring in the boxes, aren't we?
Yeah, we are. Exactly that, Ryan. It's check another one, and coloring the little cases of the picture. And well, I guess the market got a bit. There's been two things actually, yeah, happening there, and that's Takata, and then at around the same time, and actually a bit later, you got that BOJ core CPI as well coming out a bit sticky. That was around 5 a.m. our time. But yeah, the thing where we got the market scared was leaving March on the table. The rest is not really new. The language is understood as being newer because he says like changing gears, and also what I think that happened there is that the market was relatively positioned for a weak yen end of the month, and he scared all of the front runners out of their positions, including me. In fact, I was smalls long sterling yen for that particular reason as well. And I got stopped out over those comments. I mean, it was small. There was no big harm done also, but yeah, I think a lot of people were in kind of a similar position and got forced out of their positions. Yeah, the fact leaving March on the table is a bit of a precision also, but it's still, I mean, the base case is still unlikely, right? Also because of the calendar, because of those wages coming out. Unless they really get like bumper wages, and the decision will be so easy that they can make a decision. When is it exactly? The 19th of March. So I mean that's going to be like a small week after we should be hearing a lot more about those wages. So that is now back on the table, let's say. Still not, I wouldn't say the base case, but the probability has risen from 10% or to maybe 25%. Let's put it in that way, right?
Yeah, yeah. I think, well, we'll look quickly at the market reaction. I think this is going to be very telling today. If we climb all the way back up towards that 150.80 level after we've had this from Takata, then that's going to tell you that the market is pretty much okay with what the BOJ are going to do. So barring a confirmation move, I'm even stronger of the mindset, and that'll be confirmed, as I say, if this moves back higher, that we're potentially facing a bit of disappointment in the BOJ trade, that the market's going to be rightly placed for it, and it could be a big buy, rumour, sell, fact type move. But price action will determine that. We all had a bounce. Now, I did try catching a knife this morning down here, just testing the support, and then when it dipped under, I scared myself out of it, and I closed it for -12, and here we are bouncing again. I said to everyone in the room, if you want to bounce, wait till I've closed my long. So yeah, I think the price action is going to be significant now we've had those comments. You think, Kay?
I think tomorrow, Ryan. Today we're still end of month, and I'd really would like to see tomorrow, or even the reaction on Monday or so, because today could be really a bit of a different day. You know, I mean, I've been saying it. I was expecting yen sales into month end, and we still may get them. You know, and now that the market is out of the front running positions, it may be cleaner, and then we have a surprise move, which takes us all the way back up. I mean, I would really see how the market reacts tomorrow, and perhaps, you know, as well after those US data. But assuming let's assume that those data come in bang in line and that there's not a lot to take away from today's PCE data in the States, I still would wait for tomorrow to see the actual reaction on the back of the comments, perhaps.
Yeah, because maybe we couldn't see what happened over the fix in Japan. It might have got a bit lost in all the comments and whatnot, and the data.
Fix was zero.
Yeah,
the fix didn't do anything. The Taka comments came right after.
Yeah, cool. Thank you. So yeah, going to be a day of watching how this yen reacts now. Does it wash out? I mean, we've been here before. We've had hawkish comments, and then it's reversed not long after. Always got to remember there's another side to a currency as well. So got to take all the data, as Kay mentioned later today. Right, just to show you that CPI that Kay was going on about, the Bank of Japan core number there, 2 points. Did you say it wasn't the Tokyo stuff out? That's next week, isn't it? I think.
Tokyo is next week. This is the core Bank of Japan one, right?
Bank of Japan one, yeah.
Cool. So that one is still sticky, and that is actually supportive for what he said, right? Because it remains quite sticky above there. But it's always they also have like different measures over there, and so they can hide behind the one that they prefer. In fact, I mean, and just to close on the fixing, the Bank of Japan, well, the Tokyo fixing didn't give anything, but I think the more important one is the one that is upcoming this afternoon, because it's the foreigners have invested so much in Japan. That they may be the drivers this afternoon rather than the Japanese themselves, because that's in-house local stuff, right?
Yeah, exactly. And just it's not big news, but the BOJ confirmed they did no currency intervention in the month of January. So that keeps going. Nothing done there. Right, coming over to some of the other data in Europe. We got what have we got? Loads of inflation stuff out. We had some retail sales from Germany, which still on the sucky side. January's numbers coming in down 0.4%. We're expected to rise 0.5% year on year. Not as bad as expected, but still a negative number there. So still looking very weak in Germany. Over in France, consumer spending numbers down a bit, but CPI coming down, beating expectations. So still keeps in the sticky category, but a drop over last month. As you can see there, the Eurozone measure coming in a pip above expectations, but down 3 on last month, and CPI coming in 2 above expectations, 2 down on last month. So going the right way, just not as fast as the ECB would like. Some Swiss data there, which Kay can get stuck into. GDP there or thereabouts. Another country with 0. Whatevers on their numbers. Spain CPI as well. Again, another decent drop in and around expected, confirming the moves down. Heading in the right direction. We know we've seen mentioned PPI has been negative numbers for quite some time in Spain. So that's all feeding through slowly, catchy monkey for the ECB there. Unemployment in Germany was up 11k, worse than the 6k expected. The unemployment rate ticked up a bit there. Then we started getting all the regional numbers from Germany, which all confirmed lower CPI numbers, as you can see there. Year-on-year numbers, although the month-on-month numbers were coming in a little bit toppy, shall we say, but as we know, everyone looks at the year-on-year numbers, but can't rule out a bit of wonkiness going on here. This CPI data has been a little bit hit and miss late. There's various factors that can come in and out of this at some stage, but it has overall shifted a gear down slightly. It had been sort of sticky for the last couple of months, but it has started to tick down. UK numbers quickly. Mortgage approvals, a nice healthy 55.2k, beating expectations and up over last month. However, the mortgage lending numbers were soft, down 1.09 billion. So that in some aspects that doesn't compute. Higher mortgages but lower mortgage amounts. That could be down to people paying down mortgages, obviously with the imposition of higher rates. When deals run out, people pay stuff down so they don't borrow as much on their remortgage. They take the opportunity to pay some off, or indeed they just remortgage at their current borrowing amounts rather than increasing it. So that's a bit of a negative, because it doesn't suggest that there's new mortgages coming in. But anyway, that's on that data. There was the consumer credit came in just under 1.9 billion on the old plastic, which I'd like to keep a look at. That rose from 300 million to 900 million, so up 600. No real big deal. We had a pretty sharp drop last month coming out of the holiday period, so still no red flags there. For the Bank of England, they've appointed their new deputy governor, Claire Lombardelli. Used to work, I think, in an economist at the BOE way back, and then has been working for the Treasury Department, now going into the BOE. ECB. Every day there's tons of these clowns. ECB's Casimir was out saying, one of the hawks saying, headline disinflation is going quicker than expected, but the core is still uncertain. He prefers a June rate cut than a smooth and steady cycle of easing. He says the ECB is to acknowledge improved inflation outlook, but should avoid forward guidance on rates in March. ECB Simkus has a different approach, says he doesn't see anything wrong in starting to discuss rate cut preconditions in March. So we're on for a bum fight in March, it seems. Another hawk, ECB's Kazakh, says we haven't kept tight policy in place long enough. So not ready to cut there. ECB's Nagel, German hawk, says would be fatal if ECB cuts rates too early, only for inflation to rebound. ECB's F.A.C.E, the ECB is looking at a rate cutting phase if there are no big surprises. Hawke Holtzman says a serious rate cut decision is unlikely before June. It's another one pushing back on potentially talking about it in March. Right, over to yesterday's US data. MBA numbers coming in down 5.6% on mortgage applications for last week, follows a minus 10.6% number last week. So a bit of softness creeping in there. The mortgage rate, let me find it first so we can show you. Where is it? Can't even find it. Am I on the right date? Where are we? Thursday. No, can't find it. Where's it gone? Should be in there somewhere, but it's not. Anyway, the mortgage rate ticked up to 7.04%, I think from 7.02%. So there could be a little bit of pressure coming in on mortgages there due to that rate just ticking back up again. GDP came out. Oh, that's not there either. Where's it all gone? Oh, I haven't changed the calendar date. That's why. There we go. There's the mortgage stuff there. As you can see, that mortgage rate, the mortgage rate came down a couple of pips, but still running a bit hot. GDP came out as well. Not much to write home about. It dropped a pip over the flash number. Nothing really to see here. PCE prices ticked up a little bit. Sales were pretty good, so that's okay. Consumer spending was pretty good. So all soft landing numbers for that one there. Over to the Fed heads. Fed Logan says slowing a balance sheet runoff doesn't mean stopping, and says that we need to discount the idea of a slower runoff pace means ending QT. Fed Collins repeats her view that it's likely to become appropriate to begin easing policy later this year. Recent economic data highlights that progress towards the Fed's goals could continue to be bumpy, the old bumpy line. Bostic, still work to do on inflation, haven't declared victory, won't be a fast march to 2% inflation and expect volatility. Feds Williams, one of the bigger hitters at the Fed, says it's still some ways to go before hitting the 2% inflation target. Sees likely to be an uneven path back to 2%. Also sees a repricing of commercial real estate. That's an artistic way of saying there's going to be probably a ton of write-downs and drawdowns, and people are going to lose money in that repricing. But says banks are overall very strong and sound. So 3 rate cuts in 2024 is a reasonable starting point. Politico threw up a headline saying that congressional leaders have struck a government funding deal, so the can might be getting kicked once more. Jobs cuts front in Germany. ThyssenKrupp may cut around 5,000 jobs as part of restructuring their steel division, according to Handelsblatt. So again, just starting to get bigger numbers on all this job cut stuff that we've been talking about here. Oof, that's that. Me done. Okay.
Yeah, shall I go now for 20 minutes of news?
Yeah, go on. I'm going to go get a cup of tea.
Thanks, mate. I think you really went through everything. I don't have much to add, right? Just quickly browsing through everything that's went on. Have you talked about the ECB plans to put in like floors and stuff?
Yeah, I haven't. I sort of left it out because it's a
long-term thing, right?
It's a long-term thing. It doesn't.
Yeah.
It's not really a market impactful thing either. They just want to basically lessen what the ECB are doing. They're going to mess around with their rates and bring it narrower, because you've got the main refinancing rate at 4%, the deposit rate at 4.5%. It's causing banks to. It's costing banks money. This is long and short of it. So they're going to do something on that to narrow that gap. I'll tell the banks to fuck off and go and make their money elsewhere. But I'm not an ECB member.
No, the only thing was the Swiss industry group this morning warns against further appreciation of the Swiss franc, saying it's still overvalued. But of course, we know that they've been moaning to Jordan at the SMB about the level of the Swiss franc for months. But even though with the Swiss franc having depreciated since then, they are still saying that the situation is precarious, that the Swiss franc remains overvalued by about 5%. It does seem that the market has a bit of ears to it, because we were trading at slightly stronger levels on the Swiss franc before they sent out that warning, and we are slowing a little bit in the Swiss franc again, getting a little bit weaker, 0.2% or so, not a lot, but it may be interesting again for what's happening after the month end, right? Because like 2-3 weeks later, we will have the 3 weeks, I think, we will have the SMB, and I can imagine, as I've been saying before, that there is a bit of speculation around what they may do or what they may say if they don't do anything in regards to the Swiss franc. So that was really all that I saw, a bit extra. You've covered all the rest of it.
Yeah, thank you very much, mate. Anything from the those numbers out, those reserve numbers?
No, Swiss. I mean, it's rare to see a Swiss data really doing massive jumps, right? But I would call them like, as people say, meh, meh, M-E-H. It's okay, just above the zero line for the GDP. Yeah, but nothing more, you know. Now, after all those warnings from the Swiss companies, the Swiss exporters and stuff, we may have actually expected a weaker revision if they really moaned that much. But it's still like all sort of in line, you know. Leading indicator also in line with expectations, just above the 100 mark, and that's about it. Really not a lot to say. Those reserves are January numbers. We know already what the FX reserves were. Moving on from those.
Lovely, thank you very much, mate. Right, well, let's move on. Ali, I'm glad that we could help you out a bit yesterday. You know, that's all we try and do here. Not we don't tell you how to trade, what you should be doing. We just share our experiences. Been watching markets long enough, so we get to see various patterns. And really, that's what FX. That's what your chart's all about. It's just patterns. You know, you see the same thing all the time, and you just got to know how to identify a particular pattern at the time and react to it. But you know, every day you come here and watch us, we're all learning. It's another day's worth of experience you put in the pipe. Bran, I remember when Bran was a complete and utter noob, and now he's been doing this for a few years now, and he's getting it. Still a long way to go, but he's getting it. And you know, it's this trading game. It isn't a fast ticket to riches. It's a profession, and you've got to treat it like a profession, and you've got to learn to get into it and find its nuances and get that experience through time, doing the right thing. So yeah, I'm glad we could help you out with that one. Right, euro dollar. Let's have a look at that one. A little bit of messing yesterday. Bit of fixed stuff going on here. We're not seeing an awful lot. We've had some big expiries around the last couple of days. Yesterday we had that 6 billion going off 108.50.60. Now today we've got another 3 odd going off, just over 3 billion going off the same area. Could be a reason why we're topping out into 50s, near the 50s. Just that option messing around. It smells like it's month end, because I've checked the numbers for tomorrow and they all drop off a cliff a bit compared to what we've seen the last couple of days. So there is maybe some option influence within this, but as Kay mentioned as well, we've still got the last day of the month hurdle to get over. So you know, be prepared for the unexpected and where prices might go. This at the moment is still looking like decent support. 107.90s, 108s. We had a little break and then it's held on the secondary move, so this is still the number there. I missed that one. I was hoping maybe over the fix we'd get another push down, but we didn't, so I'm sitting on my hands a bit, but I'll keep an eye on that. Overall, that's where I wanted it to hold, to keep this trend momentum going. That this is the important area for me at the moment. Under there, then 107.60 is a bit of a line in the sand. So yeah, we're keeping this trend going, but get over today and then see what it wants to do. Are we going to finally get a move up towards 109 that everyone's looking at? Euro sterling, this was another one. I had a little nibble yesterday over the fix, 63 short, just playing off this top side resistance. Didn't do anything, and I scratched it this morning because I can't be bothered to sit in a trade 6 pips off the potential high. I'll let it do its thing. I'm still core long anyway, so that was just a little fixed trade, but banged its head up here on the 70s once again, so that's no real surprise. So here we are playing what are we going to do next? We stopped going down, but we can't seem to go up much either. So another one that's a bit of a coin toss. So good luck with your trade on that one, Ali. Stock's going to look at the S&P quickly, because I've been obviously following and trading this one. It's looking like my bearish, more bearish looking scenario is playing out. Rather than a move back above 80s, we got the move back down to 50, 50, 50, 40. It's held on a first test, so that's good news. But this is telling me that now that sellers are getting a bit more confident about shorting up here. You know, we've had the highs, secondary high. Now we're back down through former support and it's holding as resistance. So this is your important numbers now. If we get above 80s again, then we go and look at the highs. If we come down through this 50-40, I'm going to suspect that there's going to be a fair few stops sitting here from all these people who chased it up through the level. Then we could be on for a move down to the 5,000 level, which is going to be the next watch level. So if we get a break under this 50-40, the first thing to watch is whether, if we retest it, does it then hold as resistance, similar to what we've done here. If that's the case, shorts are probably going to try and push their case a bit more and see how low they can push it. Just depends if there are dip buyers waiting. Where are they waiting? The 5K level is going to be the big one, but I'm going to keep an eye on some of the smaller levels, 50-30, just to see if there's anything around there. But at the moment, shorts are giving it a go, but they need to break through this level down here. Okay, you want to have a little look around?
Yeah, we can.
Where am I going? There. Boom, boom, all yours.
Okay, pop, here we go. Right, yeah, as you can see, this move on the dollar yen. I'm going to run through a couple of yen crosses and dollar yen. So we've broken through this bit of a what is it, triangle, whatever you may call it, broken down through there. But this 149.4070, which we have been talking about already a good number of times, held it. We are bouncing back now, and again, I'd love to repeat that what we see here now today may still be month-end stuff, okay? And then we see the real move unfold either after the US data this afternoon, or even tomorrow or next week, if the market wants to really trade what's upcoming after the Bank of Japan comments. We still have until the 19th of March, yeah, before we had the Bank of Japan. We have those 12th, 13th of March second round of wage negotiation results. We should have results there. So ahead of that, I could see a bit more speculation on the yen, perhaps. So I would say that, to the best of my knowledge, that this 150.6080 zone is still going to be a bit of a hard nut to crack, unless we see stellar US numbers in between, of course. Whatever happens today into the 4 p.m. Fixing, London fixing, I would relatively ignore it. Well, ignore it, of course, the move will be there. But the reason why it will be there as well, it's probably just going to be month end. And then we are going to see what we do with it tomorrow or next week. There's an interesting one that I've been following, and I had this little position in. Look at what's happened on sterling yen as well. We had the break here of that trend line. This is my stop was just below yesterday's low, so I mean no real harm done. But I reloaded just smalls today because we are holding the 4-hour cloud, and that's been playing since the start of February, really. It has been playing, and also we had a bit of a setback on the Bank of Japan, but you can see that those steps still seem to be valid right now. Again, it's a month-end play. If I see a move into the 4 p.m. fix and it goes up, I will be very happy to take the profit and get out of there before March starts. But interesting is that sometimes those levels, they do play up, they do show up in those clouds, especially when you look at yen pairs, because the Japanese do look at those yen pairs. Okay, Swiss, yeah, Bram, Swiss, is that what you were asking? We're still struggling with the top end of this channel in the Euro Swiss, so I would still watch what's happening, especially for when March will start. Again, this afternoon, fixings, we don't know what's going to happen. There could be a bit of Swiss demand, perhaps. We may see a bit of a setback again, but watch what's happened in the start of the new month. So the prior tops, 95.55.60, and then I'd say the 38.2 here, around 95.75. If that would go, then I guess there's going to be enough power in this move to go back into what we saw November when the big drop from for the year end started. There's a possibility that this moves back up here for a retest, and that's really what I've been saying already. What we need to see for all the Swiss pairs to continue, and this one is no exception. So as I've been telling already, dollar Swiss coming back a little bit from those resistance areas. Watch what's happening in the new month. If we start to break above 88.40, but especially confirmation through 89, then I think we are on our way to levels above 90. Okay. On the other side, if we start March and we start to break below this spike, little spike low here, 87.5, but that's a bit close, especially here, I would say. Those high 86s, if we start to get back below, that would probably mean less good news for people who are trying to play the short Swiss side still, which I trust we are, a few of us looking at those, looking for more Swiss weakness into the S&P meeting in March. What else? Yeah, I'm still keeping a very close eye. I didn't re-enter here, was waiting for the month end in dollar rand, still waiting. We'll see what happens if ever we get closer to those low 19s. I may get tempted again for a push higher into March. The rand data PPI about as expected, but slightly up on a little bit up on the last month. The rest of the numbers was relatively a mix in South Africa, but I think it's still a case of also playing the geopolitics in that one, and we're keeping a half eye on what's happening in China and Russia and stuff. Anything else? Oh yeah, this Aussie Kiwi. Back to the retest, and we are back there. We are shying away from it again. This is going to be one as well to watch once the new month starts. 106.85.90, 107, and then 106. That's a bit higher up. This is going to be more in the 107.75 zone. But getting back into it, there may be people needing to cover smalls, but if the RBNZ Kiwi setback was a little more than a repositioning, this could find tops and starting to go down a little bit. I will make a decision on that one once March starts again. I am looking at some comments. Oh, okay. Right. Okay. Yeah. Really, read the TFP. Yeah. The good thing, and just repeating for people, there's some stuff going on TFPs around the globe, but in our area, the good thing is that when people do these TFP things, they get at least temporary access to our chat rooms as well, and that's probably the for us the most important thing is that we can help people live in our rooms. We've got to look a little bit like to those euro crosses, right? Those euro crosses are really pushing higher, especially against the commodity currencies. Yeah. We are again pushing against this 167 on the euro Aussie. I'd say this is another one to watch for the start of March, whether the euro keeps its bid tone or whether we are going to rethink what's happening in markets. But this is a break, right? Around 166 the figure, 165.85, 166 the figure. This is a break on the euro Aussie. So if we get a retest here of this zone come early March, pay close attention to what's happening here. Equally, if we start to break above the 61.8, 167.10-ish, it may push through right up into the 168. Euro Kiwi as well. You know, Euro Kiwi as well. It's seen a big push higher, and we also are breaking. We're still in the big triangle, but that's a real big triangle, this one. But we did break above 167.40, this little line here, and there was a cluster of resistances between 177.80, 178.05. We are in that zone, and again here. If you hold those prior highs to start March, we can push through back to the 179s where the January high lies. Okay, If we start to get back below 167.30, I think bad news for this cross. And both will play, in my opinion, as well the Kiwi as the euro side, all right? Because the euro, central bankers are pushing back, but if we see numbers in Euroland starting to be a little bit average, I would call them, it may not be so good for a lot of euro pairs. So there's, I think, quite a bit of interesting developments that we can see starting March in most of those crosses. And if you look at, for instance, what's happening on the euro CAD, exactly the same thing, trying to break. We're above 147 now, all right? But we are not too far away. So again, here, watch what's happening, and I would say let this month and go by, okay, for those who want to have a bit of a clearer picture, because I mean this afternoon anything really can happen. But watch where we are versus this 147 once we start to get past the month end and into March. Okay, if we push through, this could easily get back to 148. Why not even go back and have a visit over there? The market is relatively bearish on the Canadian dollar, right? So that's yeah. Thanks, Gavin. Yeah, 78.10. Okay. Well, we are right there, by the way, on that Euro Kiwi, right, as Gavin is saying. And so on all these crosses, we are at very interesting levels because we are potentially at break levels to trade quite a bit higher. But we still need to see how the reaction will be come tomorrow or even start of next week. All right. I think that's kind of it for today. I mean, Euro Sterling. Yeah, I know Ali is still in the Euro Sterling, but it's really. It's a tough one. Watch 85, 70, 70, 70, 75, but and stretch it to 80. Really but watch it once the month end is over. I'd say sterling is still one of those currencies that I think could do well this afternoon. But then again, a new month will start, and then we will see what happens here, because there's a lot of attraction of this 85.5 right now, and if we start March and we can still can't move away too far from this zone, give and take 20-25 points up or down, it's hard to see a new trend develop. Okay, but that will be for March. Yeah, play the magnet scalps, man. That's in crosses where we trade ranges. That's a very good strategy for as long as we don't break. You make some, maybe not massive, but you can keep your account ticking over and make some money in trading the ranges. And with that, Ryan, I think that's more than enough for today, and I give it back to you.
Thank you very much, mate. I'm going to grab it quickly. I will take a quick look, Ali, at your nat gas. Very quick look. What should be your first profit target? Well, you got in a decent trade first and foremost. Can you see my screen okay, Kay?
Yes, we are, mate.
Yeah, cool. So I've basically knocked this up. My screen was blank of technical indicators. I've knocked this up while Kay was speaking. Okay, this is what you have to do. I don't know what your chart looks like, Ali. So I've no idea what you're looking at. You got in your trade. It's had a decent bounce. Where do you want to start taking profit? Well, what you got to do is build the picture up. The first thing I use is fibs. So we've had a big down move, and you can take it in two parts. The bigger move from November, and in this secondary move here from the start of the year. So fibs are my good indicator of how the trend's reversing or stalling or stopping or whatever. And then what you need to look at is confluence of levels. Are there levels all clustered around a particular area? In this case, around this $2 mark, there's a bit of there between $2 and call it 210. So there's a bit of technical levels coming in there. Obviously, the $2 mark is a bit psychological. It was support on the way down. So that's probably a number to look at if you're looking to take profit. Okay, then that's your area. When you get up to that $2 mark, that's what I would be looking to take profit. What you do, obviously, is down to you. I can't advise you on that, but that's the area I'll be looking at. Where is the price going to run into trouble? That means whether you're making money or whether you're losing money. Where is the price going to do something that goes against what you're trying to do. The $2 area, 210, is where I'd look. On the other side, if you haven't taken any profit already, then here's a little bit of a level here, coming in at 184. We resisted it on the way up. We broke it. We're now holding it as support. So if you get back under there, things might not look as rosy. So that may be, if you're going to move under, that's somewhere to think about then taking some profit if you missed stuff up here. But what you've got to do is get on your charts, look at the levels, look what happened on all this coming down, because those are the levels that you've got to look at on the way back up. Okay, so whatever picture you draw here is valid the other way. You know, you can't ignore these levels on the way down. Sorry, you can't look at these levels and trust these levels on the way down and then ignore them on the way up just because you don't want it to stand in the way of your profits. So do the homework, get on your chart, pick your levels, drop your lines in, see where the price may do something, and that gives you your deciding factor as to when and where you start to take profit, move stops, and all the rest of it. And on that note, that's it for today, folks. Thank you very much. Trade safe for the rest of your day. Thank you, as always, to my colleague K-Man for his valuable insight. Have a good day, everybody, and we'll see you all tomorrow. Have a good one.
Have a great day.